Right, attention everyone. Good evening and a very warm welcome to you all. And thank you very much to everyone joining us online tonight. It's great to have you here for a very special night to our one and only Alan Clement. Now, Alan's been a system designer for many years now, and also one of our top lecturers in Victoria, if not Australia. So it's with great pleasure that. Thank you, Alan.
Thank you very much. Thank you, Paul, for that wonderful introduction. And just before I start tonight, I just wanted to mention that we do have the online conference coming up in October. We've got a really excellent group of speakers there, as you can see, Kevin Davey and Brian Shannon from the US. Then we've got Louise Bedford, Mark Bonnell, Adrian Reid and Chris Weston, all locally. It's a one-day conference. It's fully online, so you can enjoy it from the comfort of your own bedroom, wearing your pajama bottoms if that's what you so desire. But there's going to be some great topics discussed and some quite cutting-edge stuff as well. So I'm really looking forward to it. I hope as many of you guys can join us for it as well. So if you're interested, jump on the website and sign up. It's very, very cheap, only $99. You won't get that kind of value anywhere for a whole 6 hours of really excellent talk. So I commend it to you. And I'll just get set with the presentation now. So if you just bear with me for a second. Okay, sorry for the delay. So you lucky people have got me for both sessions tonight because as it is September, it's time for another one of these, another quarterly market update. So we'll whip through that, and then in the second half, what I would like to share with you is a sneak peek of a brand new presentation I've put together that I'm planning to take to the IFTA conference, which is happening in Henan, China in October. So I thought I'd give you guys the opportunity to have a first look at it and see what it is. And hopefully you'll be able to give me some feedback as well that I can use to polish it up before I head off to China. And it really is some cutting edge stuff. Hopefully it'll be novel material for most people in this room and online, looking at how we can harness artificial intelligence to improve our performance and our results in the trading world. So stand by for that. But before we get there, this is the technical quarterly update for Q3 of 2024. All the material in this presentation is general in nature. There's nothing that constitutes a recommendation to buy or sell any financial instrument. Please consult with a licensed financial advisor before deciding if any investment is right for you. And with that, we'll dive straight in and have a look at the long-term chart of the S&P 500. There's a monthly chart on a log scale, and you can see how it is still very much in the middle of that very well-behaved uptrend that we've been in right from the GFC, really, right, that 2009 low. We haven't really breached, apart from maybe back in the COVID times where we just kind of sliced through the trend and immediately reasserted itself. But we're still right in the trend, and the market is heading up and to the right. So at least on this time, we can definitely say we are very bullish, the US market. However, when we dive into the weekly market, we do start to see there is just a sign of some volatility starting to enter the market. It's, as you can see from the bars leading up to the last few weeks, it's been very quiet in terms of volatility. Now we're seeing that volatility start to expand a little bit, and we do know that, you know, when markets come into some kind of top, they tend to start to exhibit much more volatility. So I just wonder if we're starting to see the beginnings of that. If we look back in what happened in 2007, you can see it's a very similar pattern where the market was very quiet. It had just a decent correction, and then we headed up and we started to see the market turn volatile. And I just wonder where I've put that green arrow, if we're kind of somewhere in that vicinity. But don't forget, after that point, it then took another 10 months for the market to actually do its thing and then eventually keel over. So if we are heading for some sort of large correction or bear market, I don't think it's round the corner. So I don't think this volatility we're seeing now is any reason to turn bearish or to go short the market. It's just something that you probably want to have on your radar and be aware of. If we look at the Ichimoku chart, you can see we're still very, very bullish. The price is well above the clouds. The lagging line or the Chiku span is also well above the cloud. And you can see that the cloud support is down at around about 480, 490. So there's plenty of room for this market to move around and still remain that maintain that bullish stance. So let's have a look now at the market internals and see if what we're seeing on the price chart is backed up by what's happening internally. So the first one we'll take a look at is the bullish percent index. This is a market breadth indicator to determine the percentage of stocks in the S&P 500 that are exhibiting bullish patterns. 64% it's showing at the moment, but what we can see in the pattern is that the breadth is starting to diverge from the price. The S&P 500 is continuing to go up, but we're starting to see the peaks in the market breadth get lower and lower. So we've got that type 1 or type A type of divergence where the market goes up and the market breadth's going lower. These can often take months to play out though, so I wouldn't again use this as a signal that the game is over for the market. Again, it's just another sign of potential weakness that we might be seeing. If you look at stocks above their 200-day moving average, it's a similar but not quite as bad picture. So you're starting to see the market breadth moving very sideways there. We're still seeing about 62% of stocks above their 200-day moving average, but the peaks are starting to level out. We're not seeing any higher peaks above that 72, 73% area. So this, you would probably call this a classic type B divergence, market going up into an indicator going sideways. And again, just another indication that maybe we're starting to reach a sort of ceiling in the market at least on a short to medium term basis. Looking at the discretionaries versus the staples. So we're starting to see now that staple stocks are outpacing discretionary stocks, and we're starting to see this ratio again starting to drop off. So another element of divergence creeping into the market. Discretionaries versus staples is often a leading indicator of where the broader market might be headed. So once again, this is just something to be aware of. The semiconductors, which you could argue is one of the sectors that's really been driving this market, it's all tied up in this big AI story. All the big growth stocks have all been climbing over each other to try and get a hold of these GPUs that NVIDIA are selling, and they can't get them out the door fast enough. That's basically what's been driving this ratio higher. The semiconductors have been pacing the market. But now you can see just lately in the last few months, we're just starting to see that ratio bend over a little bit. And once again, we're seeing that type 1 type divergence creeping in. However, if we look at the advanced decline line, we can see this actually still is agreeing with the market and actually showing a very bullish picture. We saw that breakout over that line of resistance there, and it's now shot up into new all-time highs. So that's a tick in the box for the market remaining bullish while we're still getting more stocks accumulating versus those that are declining. If we look at the relative performance of the three major indexes, the S&P, the NASDAQ, and the Russell, you can see how the S&P and the NASDAQ are maintaining that performance in the mid-teens or so, 16% for the year. And the Russell's was kind of just poodling along. It might be a bit hard to see on that chart with the color of the green line, but it exploded just in the last 3 months to the upside. Everybody thought that was it. The small caps were taken off, but it wasn't to be, and it's kind of dribbled back down. It's now up about 4% for the year. But I guess the big takeaway from this chart is you can see that how the performance prior to where we are has been much higher. So up around that area there, you can see the NASDAQ was up about 22%. It's now come back off quite a bit of that, and you can see the market or the performance to date, at least, moving much more sideways. Having to think about the sentiment, though, and we can see one of the reasons why money might be leaving the stock market is due to this large inversion of the yield curve that continues to gnaw away. Those shadow lines show where the yields have been. The yields are all coming down as a group, but we're maintaining that inverted stance. One reason for that, of course, is because the Fed's cash rate still remains high at the short end of that curve. That's pulling up those short-term yields. So we know that if you look at the betting markets, at least it's showing that the Fed is highly likely to start cutting in this next cycle in the next month or two. So that's going to see that short end of that curve start to fall down, and the curve will either less invert or it might actually normalize. But what do we know about an inverted yield curve? Well, we know it often precedes a recession in the economy. And if we look at the probability of that occurring in the US in the next 12 months, that's sitting around about 52%. So about a coin toss, but it's still not nothing. So it's basically a 50-50 chance that we'll see a recession in the US in the next 12 months. And that can happen as rates are falling. In fact, it's quite common for the Fed to start cutting into a recession to try and stimulate the economy. So we might see both of those things happen in tandem. On the put call ratio, you can see just there how it scraped that right about here. The put call ratio dipped below that what's the lines named the bullish extreme. That's when the market starts to get a little bit overheated, and that's probably when we saw that big fall that we saw recently. And we'll have a closer look at that. The reasons why the market might have fallen off a small cliff, as it were. But at least for this, you can see that the put call ratio is now reverted back into the middle of the range. So it's not an extreme high or low. Again, that's one reason not to turn bearish on this market, because we're still seeing sentiment basically in the middle of things. There's no extreme fear or extreme bullishness. But this is the big chart that's kind of had a massive change. The VIX, which had that huge spike up in volatility, the highest print that we've seen on the VIX since the COVID crash. And the reason for that was the Japanese central bank decided to put their rates from minus 0.5% up to just above zero. Who would have thought that could have such a dramatic effect? But the reason why it did is because of the so-called carry trade, where people were borrowing in yen and then they were making bets, or they were collecting the interest in US dollar. And so as soon as that interest rate differential changed, then a lot of those margins plays had to be unwound and be repaid. And that meant that a lot of the money that was borrowed in Japanese yen had been funneled into these large growth and AI stocks. So they all got sold down quite hard. But after the hangover passed, people realized that there is actually still quite a big differential between the US interest rates and the Japanese interest rates. So the carry trade actually maybe wound back up. But in any case, the stock market itself settled down. So you can see that we're back down now in that low risk environment under 20. So there's no massive demand for protection for portfolio managers at the moment. So once again, it's steady as she goes. This is one we looked at last time, so I included it again. The CNN's Fear and Greed Index, and you can Google what goes into it. There's about 6 or 7 different elements that go into it, so sort of combined measure of overall market sentiment. Last time we looked at it, it was sitting right in the middle at neutral. It has been right down at extreme fear on that side, but it's bounced back up a little bit, and it's now just sitting in that fear spot there. But you can see it's not. I mean, it's almost back in neutral. In any case, the takeaway is that there's no extreme sentiment in either direction in this market. So there will be buyers around, there will be sellers around, which maybe indicates we're heading for some sort of sideways action, or maybe it just drifts a little bit higher. So as you can see, there's quite a lot of sort of conflicting signals that we're starting to see in the market at the moment with this increasing volatility, but something still pointing to be quite bullish. So I thought it would be a good opportunity to bring back the infrequent series that I do called Where to From Here, and we'll look at both sides of the argument about where we might head from here. So first of all, on the bullish case, well, this is an interesting stat that I picked up, which is that October has the highest number of starts of 10% rises in the market since World War II, far and away more than any other month. So if we're at some sort of corrective low and we're going to see a 10% swing higher, there's a good chance that might start in October. So that's certainly one reason to be bullish as we go into October. The other thing is the market seasonality. The last quarter is the best time for the stock market. I think we kind of all know that empirically or experientially from being in the market for many years. But starting in October, that's the time when the market is most likely to rise. So the seasonality winds, if you like, will be behind the market going into the last quarter. If we look at what happens to the market when the Fed start cutting, as they're expected to start doing, the first rate cut can do one of two things, and it depends on whether the economy is in recession or not in recession. If it's not in recession, which it technically isn't at the moment, then it can be very bullish time for the market, which is that top green line. However, if it's in recession, it's more likely to be that bottom green line. So this is kind of a case for the bulls and the bears, I think. I mean, my sense is that the bear markets are usually going to occur in recession, so that's what's feeding into that lower line there. So it might not be as bad as that actually takes. But if you're bullish or bearish, you can get something from that chart. If we have a look at the bearish side, why might the market not recover to new highs? Well, we are actually, at an extreme high. We're at all-time highs. The market has been going up a lot. There's no question that this market is very overextended. Goldman Sachs have something called the bull-bear market indicator, and again, it's a number of things that goes into it. But the interesting thing about this slide, as you can see, we're sitting up around about 70% at the moment. And if you look, those blue bars are where bear markets have occurred. So you can see those bear markets have often occurred after this indicator has been up around about that 70 level. So that's another thing that might make us pause. And the other bearish thing, as I've already mentioned, is the carry trade, which has imploded basically. You can see how correlated it is with the S&P 500, because as I said, the carry trade is not just selling yen and buying US dollars, or sorry, is that right? So it's borrowing in yen and buying US dollars. It is actually also using the loans in yen to actually buy into the stock market, because you'll get better returns than just holding US treasuries. So when the carry trade imploded, we saw the US yen cross collapse, and the S&P 500 obviously started correcting. This chart's a few weeks old, so the market has since recovered a little bit from them. So we'll see where it goes from here. There's definitely cases on both sides. But if we look at the seasonality, the annual seasonality, now you can see that last quarter in this chart here, as we sort of zoomed in a moment ago, is where the most bullish time of this market is. The year to date is on the bottom there. You can see, you could probably make an argument that we had that correction in April, which lines up fairly well. The market's supposed to go into this kind of northern summer doldrums through the northern summer months, where we haven't really seen that. The market sort of crept up. But now we've had this volatility come into the market, which the cycle doesn't forecast. So we're kind of a little bit out of sync, if you like, with the seasonality, and we'll see what happens if the market dips into that early part of October. Will we still get that Santa Claus rally towards the end of the year? We can see that if we look at the average returns for the individual months, September is one of the is the most bearish month there is in the whole calendar. So it's no surprise that the market's taken a hit right where we are at the moment. But the other side of the coin is the last 3 months are the most bullish trio, or at least the most bullish consecutive months in a row. So that's certainly something to think about if the market certainly does turn higher. And we're in a US election year, as I'm sure it's inescapable to know. We did have a sitting president running the last time I gave one of these, but that has evaporated, and we've now got. Well, what have we got? You know, some people are saying that Trump's acting like the incumbent because he was the former president. So maybe we've got, you know, maybe we are still in that sitting president running, or maybe we are in a wide open field. It's very difficult to say. I mean, my tendency would be to take the average, which is the black line, and see what happens there. Again, the year to date's down the bottom, which, you know, you could say, you know, overall the black line is fairly bullish, and it does kink and then tip up towards the end of the year as we come into that election, which happens in early November. So that's the US stock market. Let's swing now over to the local market. And well, it's a very, very bullish picture for the Aussie 200. There's no question about the direction that it's heading in. Certainly hasn't exhibited much of that same volatility that we've seen in the US markets. On a monthly chart, we've broken through those old all-time highs at 7,600, and we're now in clear blue sky, moving higher. And as we see on the weekly chart, you can see that after breaking that 7,600 level, we've actually come back twice to test it, and so it's now reasonably solid support. And once again, we're moving higher. So you could argue we're maybe playing catch up because, as you'll see in a moment, we're still not that good on a year-to-date basis versus the US market. But there's no question that this market is very bullish. And that's kind of borne out by what's happening on the Ichimoku chart. Both the price and the Chiku span, both well above that cloud, which is sitting around about 7,400. So that's what we would expect support to come in if the market did correct back to that level. But yeah, if we compare what the Aussie's doing compared to the rest of it, you can see that, you know, we're sitting on about 5% for the year, which is, it's not nothing, but it's fairly anemic. Compared to the Hang Seng's the only worse one out of these five, which is more or less a wash for the year. And then you've got the Indian Nifty and the S&P 500 up around that 14-15%. And then the Nikkei, which was kind of powering ahead, as you can see, right, it was up 26% for the year at one point. That's now come way back off, and it's now up just about 6 or 7% for the year. So we're at the lower end of the pack, which means that, you know, the ASX 200 certainly has got some more headroom should it wish to move higher. On now to the currencies, and I guess the big news, as I've said a couple of times already, that the Fed, we're expecting the Fed to start cutting their rates. That is bearish for the US dollar, obviously. So we're seeing it sell down. That 100 level there is turning out to be a key level for this market. I mean, you could make a case for it being a little bit of a sort of descending triangle that it's trying to build there. There will be a lack of demand for US dollars if the rates go down. There's no doubt about that. So should it slice through that 100 level, then we could be looking at to make a move back towards 90. And so what does a weak US dollar mean? Well, for the rest of the currencies, it's actually quite bullish. The Aussie dollar itself is kind of putting in this nice little base here. As you can see, it's managed to sort of stem the massive downtrend that it's been in. And it's trying to make its way back up to that 70 level. So if the US dollar starts weakening more, then it's going to have a little bit more of a tailwind to try and get that 70 level and above. On the euro, well, the level it had to hold was that 105, which it has managed to do. And again, that weakness in the US dollar is starting to push the euro higher. The next key level for this is that downtrend line, which has been in place since way back 2000 and what was that, 9, 6, 7, 8, something like that. which is sitting around about 112 at the moment. So that would be the key level for the euro. We may see some resistance at that area, and it'll be interesting to see if it can get above it with a weakening dollar. But the big news, I guess, is the old Japanese yen, which they made that rate announcement right on support. So you know, you can say what you like about technical analysis, but in this case, it worked a treat. And as we'll see in a moment, that was a very key level that it had to hold. But you can see that what looks like a tiny little move at the end of the chart there. Yeah, it's a monthly chart, but that tiny little move had all that devastation that we've seen already in the stock market. So so that was a big event. It was, you know, you could put it in the black swan category because nobody was expecting it. Caught a lot of people off guard, particularly those that were invested in the dollar yen carry trade. But yeah, if you look at the quarterly chart in the yen, you can see where that support line comes from, which is way back in 1990. So that was in place for a long time. If it hadn't held that, well, who knows where it might have been headed after that. It was into uncharted waters, but it has held it for now. So so we'll see how it does from here. And wrapping up on Bitcoin, you can see that, well, that $69,000 level has really been a stiff area of resistance. You can see where it was set back there in 2021, that was. The market has been all the way down, has been all the way back up, and it, you know, it's tried once, it's tried twice, it's tried 3 times to get through that 69 level, hasn't been able to do it, and you can see it's just dribbling off back into the middle of the pattern. I think the key level for Bitcoin has got to be that 50 grand level, which is where that spike from a few weeks ago is sitting on. That's obviously a key psychological level, so so that would be the key level for Bitcoin. And rounding off on the commodities, the big story, I guess, is the weakening of oil. It's been dribbling down. So despite the weakening in the US dollar, oil is still being sold off. You can see it's turning into a little bit of a descending triangle there. That 63 level, for my money, is probably going to be the key level. And if it plows through that, well, that could be quite a sharp move because you can see how long it's spent consolidating above that level. On to copper now, and you can see, well, if this is a weekly chart, and you can see, I think last time we ran this, we were looking at that spike, how it blew out of that symmetrical triangle and then just took off like a rocket right through that old resistance level at $4.65 a pound. But you can see it wasn't to last. It blew up and then immediately came back down. It's retested that level from the underside, so that's now resistance. And then coincidentally, it's actually come all the way back to the breakout level of the triangle and just found some resistance there. So looking very much sideways now for copper. Well, sideways to bearish, I guess you could argue. Iron ore has been weakening. That's you've probably seen that if you've been following the news. Obviously, the slowing economy in China is the big story for iron ore. And in terms of key levels, it wasn't able to hold that 130 level at the start of this year. Just spent a few weeks above that, and then it's dribbled back down. And it looks like it's going to make a run for that level of support at 80. And let's always nice to finish on a high. So gold is still maintaining that that rocket-like stance that it's had since that breakout there from 2002-08-07. It's just gone off, and it's not looked back. I mean, you could say that it is starting to look quite extended to the upside. It's starting to, like, it's running out of a bit of momentum. The bars are getting smaller and so on. So I would expect some sort of pullback. But again, a weakening dollar is not doing gold any harm. And, you know, if you speak to the gold bugs, they'll tell you it's a hedge against inflation. So that's maybe another reason why it's very bullish at the moment. So just to summarize that, US stock market still, for my money, looking very bearish. If you've got positions in the US stock market,
You said bearish.
Bullish, sorry, bullish, bearish. US stock market still looking very bullish. If you've got positions in the US stock market, I certainly wouldn't be considering selling them right at the minute. But we are starting to see that volatility increase, and we're also starting to see divergences starting to creep into some of those market internals. So just be aware of that. The Aussie 200 looking very bullish also. We had that breakout. It's close to all-time highs, and there's no sign that it's wants to stop anytime soon. On the currencies, the US dollar and funnily enough, the Bitcoin both weakening. They sometimes move together, sometimes move against each other, but they're both weakening. And that means, especially for the US dollar, we're seeing strength in certainly the other majors at the moment. And on the commodities, the oil and the industrial metals weakening, but gold is the one that's spiking higher. Checking in with a couple of the strategies that I trade. The Monterey, the Nasdaq rotational one, it's obviously taken a little bit of a hit rate lately because of the market sell-off, but still well up for the year. And I don't doubt if the market goes sideways, it will tend to do quite well. And then Dolphin, my little mean reversion one, picked up another winning trade this week, so it's back at all-time highs again. So very happy with those two. Systematictrading.com is where you'll find out more on those. And with that, I will thank you for your interest. Wish you good luck and good trading for the next quarter. Bye for now. And if you just give us 10 minutes to reset, then we'll be on with round two. So stand by.
We'll be back in 10 minutes.